Hello everyone, welcome to our DebtCircle podcast. So over the past few weeks at DebtCircle, we have been talking a lot about bonds, but majorly all our conversations have been focusing on issuances, opportunities and yields. But there is another side of the market that is rarely or not talked about much. That is what happens when something goes wrong. So, as a continuation of our recent article, and to understand that better, today we are joined here by Mr. Anil Grover. He is CEO of Beacon Trusteeship Ltd. Sir, thank you so much for joining us. We will start with our segment one. So, before we get into details, defaults and stress situations, let's start very simple for our viewers. What exactly does a trustee do in a bond transaction?
Yeah. Thanks for having me on this podcast. The trustee, what it does is in the entire debt market, there are a number of stakeholders. And out of that, the stakeholder, which is the most important, which is the silent one, is the trustee, whose job is to ensure and protect the investor's interest. And what it does is, first of all, it ensures that all the terms of the issues are complied with. That is a due diligence at the time of the initial opening of a particular bond, and post that ensuring that the continuous due diligence is also being done as per the terms of the agreed issue. So that is all what it does during the entire life cycle of a bond, ensuring that the company, the issuer, remains healthy and is solvent and is able to repay the debt well within time. So that's the overall monitoring what it does. And in case the bond turns sour or the fortunes of the company turn sour, in that case the role of the trustee becomes the most important, wherein the enforcement and all kind of measures which are taken. So that's all the paraphernalia what the trustee does.
That is very insightful, sir. So, if I have to try to understand down basics, is the role more legal, operational, or we can say investor focused?
So implicit is investor focus.
Okay.
The type of job what it does is operational and legal in nature, because ensuring that all the terms of the issue are appropriately captured in the loan documents. In this case, what we call is DT and DTD, that they are the largely terms which are used in this particular segment, which is a debenture trustee agreement, which defines what all is required to be done by both the parties, the issuer as well as the trustee. And next is the DTD, which captures the legal details of all the security which is offered and ensures that the issuer is complying with that. And tomorrow, if you need to go to courts to enforce any of these, all of these are produced and are recognized as evidence by the courts of law. That is why understanding the legal part is the most important job what a trustee does. And from operational standpoint, it is said that trustee industry is the most operations heavy. That is from the perspective that it is not only doing due diligence at the time of initial onboarding, but it is a continuous basis, ensuring that everything is being complied with, is being checked, is being monitored, so that the health of the issuer remains in check.
Yes, the word you used, the health of investor, it's a very interesting term. So, I want to bring your attention to this question too. So, most investors hear about issuers, arrangers, and investors, but trustees rarely get talked about, although it's an
Yes.
important role. Why is the role you think is so invisible unless something goes wrong?
So let us look it from the perspective of the of a particular investor. What investor is interested in is he has invested money and he wants the returns well in time.
Correct.
Right. And when we are saying returns, these are both the interest as well as the principal redemptions. So these are the two things anyone would be interested in. Second is he wants the committed coupon to come to him well within time, right? So when the investor is looking at it, as long as he is getting that, he is not even bothered to check what is the paper, what is the company doing, what all is happening with its management. It will not even bother unless there are some top of the line or some allegations which come against the company. Only then you would be bothered. In most cases, 99% plus cases, as long as he is getting the money, he is not bothered that who is the credit rating agency, who is the arranger, who is the merchant banker. Leave aside trustee, right?
Okay.
So now when anything goes wrong, which is the duty of the trustee to monitor, right, on a continuous basis, then only anyone would think that now whom should I go and contact as an investor. Then he looks for that who is the person whom I can
Like,
blame
go to.
and who can actually help me to do the recoveries and all.
So it also means that this invisibility actually means the system is working smoothly, right?
Yeah.
So on the same lines, what do you think a trustee is monitoring quietly in the background during the normal period? I mean,
So, as I enumerated earlier, that at the time of the initial onboarding, the trustee's responsibility is to check what are the, in case it is a secured bond, to check whether what is the asset which is offered as security. One, two, what is the authenticity of that particular asset which is offered as security. Third is what is the valuation of that particular asset which is offered as security. Right. So these are the
Okay.
three things which particular trustee has to see at the time of onboarding.
okay.
And now going forward, till the bond is lying, ensuring that the security cover continues to be adequate.
Adequate.
The asset which is offered is always able to cover both the principal and accrued interest of that particular bond, right? And for doing that, it what it does, it continuously asks for the various sets of information data from the issuer. One, two, it would check what are terms and what are the covenants which were stipulated, be it, apart from the financial ratios, but it'll check, it will keep on asking for the financial statements, and to ensure that the company is continuing to be profitable and continuing to be, able to raise the money and refinance all its requirements. Three, in case there is a management control, it is checking whether there is a management control and whether it can have any, negative impact on the bond. Fourth, what it will do, it will also keep on checking whether there is any impact coming on account of change in the management control of the company, so that it would ensure that if there is anything which is happening, any of these nature which is defined in the terms of the document, that is being complied with. So that's all which is happening silently till the repayment is happening. Right.
Okay.
Post that, the trustee comes into different action.
Okay, so that's quite very detailed role that a trustee plays, although we might say it's most of the time invisible. So my next question to you, sir, is from the outside, the bonds often look like straightforward fixed income products.
Yeah.
But beneath the surface, how complex is this unlisted debt market actually?
So, unlisted debt market, or now a term which is being also used is private credit. Both of these at times are being used interchangeably now.
Okay.
So, in this market, most of the times it is the investors and issuer, both of them agree,
Yeah.
right, on the terms of the issue. Right. So normally an investor evaluates, does the entire credit evaluation, post that it to mitigate the risk. What it does, it puts some risk mitigants there. The appropriate covenants are stipulated so as to ensure that if there is any incipient sickness which is observed, that is, those early warning signals can be spotted well within time.
Within time.
So that's all what is done by the investor due diligence. Right.
Okay.
And these two things, in case of the unlisted market, most of the times the investor base is limited at the time of the onboarding. However, at times these are distributed to different investors, different HNIs. So in those cases, the evaluation which is done by the anchor investor that is seamlessly required to be passed on to all investors. So in those cases, the SUA, the investors, they definitely evaluate everything. And in those cases, they also look at the covenants which are stipulated so as to ensure that the yields, as they are there, yield price relationship is appropriately captured. Right. So that's all what is required to be done.
Okay, so can you also tell us what would surprise retail or even HNI investors, how those deals are structured operationally?
So as far as HNI investors are concerned, so at times they are guided by the arrangers who are arranging these deals, and nowadays even the OBPPs who have come up. So many of these bonds are even offloaded by the OBPPs also. Right. So in those cases, the headline information pertaining to yield, tenor, credit rating, that is available online. Transparently it is available. So based on that, investor is able to take a decision. However, what it is required or how it gets surprised when the underlying risks, the yields, what he is getting, if the two are not aligned, at times there is some kind of minor shock to the investors in case things go south.
Okay, okay. Can we also say, sir, that documentation and covenant protection is becoming more sophisticated day by day?
Yeah, that is definitely becoming more sophisticated because in case of the listed market, if you see, AB came out with the guidelines, and there was a separate covenant module which has been already implemented by way of DLT platform. It is the central repository of all the listed bonds in India, which SEBI stipulated and was developed by NSDL with in coordination with the trustee association. So that is how it was developed, and all the covenants of each of the listed bonds are available there. But if we talk of the unlisted debt market, which is the topic of discussion what we are having today, so there is no uniform repository which is available as of now. It is the individual trustees who are as of now monitoring this as per their own systems and processes.
Correct.
That is the kind of monitoring which is being done. And as far as the question what you asked, what is the complexity of these covenants and all, so that has quite evolved with the kind of defaults etc what we have seen in these markets. So as we learn from the past mistakes, we keep on bringing that in, and that is what investors have tried to put in there. That's why at times it becomes more complex. But as most of these or many of these get standardized, then the market starts accepting this.
Yeah, so basically learning from the past and
Yes.
upgrading on its way.
Right.
Yeah, so viewers, we are moving to our second segment. Sir, my next question to you is, a large part of India's debt market still operates through unlisted structures.
Right.
Why do you think that is the case?
So, number one is the flexibility it gives to the investors to structure the deals. Second is the regulatory requirements. At times, there are some regulatory compliance costs, what we call. So, that is second. Third is the speed with which it can happen. So, these are the three major reasons why unlisted market operates more. And if I combine all of these, most of the private credit, the way it runs, and the segment of customers, be it say startups and all, if AIF, which is credit fund, if it intends to invest, normally it finds the investments in this particular space, wherein unlisted debt becomes the most prominent ones to be used.
Okay. That's a very important and enlightening thing to look at. So, sir, do you think India's fixed income market has historically lagged behind equities in terms of investor participation and awareness for that matter?
It definitely has played second cousin to the equity market in the capital market space, and the reasons are quite obvious what has happened so far. And the regulator has also tried to pitch in wherever possible to increase the participation. So So things are moving in the positive direction, but the reasons why it has not happened so far is, that there is no depth in the market. That's
Okay.
one. By depth, what I mean is the liquidity. So
Hmm.
liquidity is low, because most of the investors who are holding these particular instruments, they tend to hold it till maturity. So if any investor is holding till maturity, then it becomes difficult to create liquidity in the market. And next is the issuers have also to be willing to come into this market and participate. So for which RBI also came out with the regulations that if any particular industry group wants to borrow more than 10,000 crore, then it has to be through debt market, right?
Okay.
And it should not become a systemic risk to the entire banking system. So in order to de-risk that system, RBI has already issued these guidelines. Similarly, SEBI also came out with the guidelines that anybody who is getting more than 100 crores, then beyond 100 crores, at least some part of this must be raised through debt. So attempts are being made by both the capital market regulator as well as banking regulator to bring the debt into main focus. However, it is still taking baby steps there. I hope with the evolving AIF market, it should now much expansion pace.
Okay. Sir, I think our viewers are also interested in knowing on the same lines that we discussed now, the question. Is it simply that equity stories are easier to sell than debt stories?
Partly yes,
Okay.
right? Because the way the equity market works is very simple. People are able to see what is in front of you. They are able to see the rates, and they are able to see those prices, and then they are able to transact also easily.
Correct.
Number one. Number two, there is growth in equity, right? What we call as the capital gains return.
Okay.
And in this case, it is the return is fixed. So the growth which can happen, or multiplicative nature of return which is available in equity, is not available in debt, because
Okay.
this is a different instrument altogether,
Yeah.
wherein a return is already fixed and you know what you are going to get.
Correct.
However, investors perceive here is that in case I invest in a debt instrument, then there is a possibility of default. That is how investor perceives, because of few infamous defaults which have come, be it LFS or DHFL or Reliance Home. So there are few where people or many of the investors have burnt their fingers. So
Yeah.
due to which they are quite scared to participate in this market relative to equity market, even though there are many people who have lost money there also, but that remains under the carpet.
So kind of trust issue we can say, a little bit of
Yes.
how it is portrayed, because of
How it
it's
is
portrayed.
perceived. These are more
Perceptional.
issues.
Yes. Oh, it's very intriguing to know. Sir, my next question to you is, now that private credit and alternative debt products are growing very rapidly,
Yeah.
do you think investors are entering the space faster than the ecosystem is maturing to handle it?
So in this, what is happening, earlier I discussed about OBPPs as well as the AIFs. So now if we bring this together, in the last couple of years, so in 2022, SEBI came out with the draft guidelines for OBPPs, and in 23 it got regulated. So if we see the growth from that day to till now, is quite sizable. We are seeing nearly 100% plus growth in the number of retail investors who have come to market post these distribution channel becoming available. Second is talked about the private credit, wherein AIFs are the one who are taking the lead. So in this also, so our private credit today has reached close to 2 trillion, right? So that's a large number which has become now. But if I compare it with the developed markets, which is US or Europe, or relative to that, we are quite far. So if we are far, so if we see from another perspective, that's an opportunity.
Correct.
So
Correct.
we feel that we should definitely be inching towards that using
Okay.
these particular instruments.
That's a very important outlook. I'm sure our viewers would agree with. Sir, now a cautionary question for our investors. So, when investors chase higher yields in unlisted debt, what are the risks they most commonly underestimate?
The most important thing at the time of investing in any of the instruments, any of the
Okay.
financial instrument, is
Hmm.
understanding the risk what anyone is undertaking, be
Okay.
it equity or be it debt,
Debt.
right?
Okay.
So in this particular space, one is expected to, as an investor or before investing, one has to do its due diligence, appropriate due diligence, wherein the investor should ensure to go through the terms of the issue, the purpose for which money is being raised, the ability of the issuer or the company who is raising money to repay at that at the agreed or scheduled timelines. So for that, it should look at least the basic things, the track record of company, number one. Number two, profitability and the revenue which the company has generated over the past few years.
So, sir, do you think liquidity risk is still underappreciated in India in continuation to what you just told me?
So, liquidity remains one of the most important points as far as the debt is concerned.
Okay.
Because the way what we were discussing regarding depth is not there in the market, in the debt market. And people are, the investors are mostly pension funds or insurance who continue to hold it till maturity. So, if that is why the liquidity becomes a major issue, and for a retail or HNI, it becomes one of the most important things, that if money is not available when needed, it becomes problem for
Problem.
that particular individual.
Okay.
However, another link to this I would like to bring here is the concept of junk bonds. So
Okay.
not only the performing paper, even the junk bonds wherein it has already happened. In case of the developed markets, there is a very big market which is a junk bond market. So in India also, around 2021, the regulator started the concept of putting a suffix to the bond paper as
Okay.
defaulted. Right.
Oh.
So it
Okay.
asked the depositories to add one suffix so that they can easily be identified that these are the defaulted paper, and so as to encourage trading around it. So trading brings the liquidity. However, if despite that it has not happened, so that is one. Now coming back to the topic of our discussion, which is unlisted debt. For unlisted, even till date, there is no concept of even identifying these. So maybe some kind of policy direction is yet to be formed here. It would help to develop even the performing market.
Okay.
So both of these are correlated in that sense.
I'm sure our viewers are also interested to know by your experience. Do you think our investors fully understand how difficult exits can become if there is a stress situation?
Very interesting. The most important thing anyone can do is to know, that is the off repeated point which I make, is return of capital is more important than return on capital.
Correct.
Right? When we are saying that I have given money, so money needs to come back to me. So if I am lured by the higher yields, then even my capital is at risk. Right? So that is the most difficult situation which can be with any investor. So from that perspective, the investor who has invested and at that point in time not understood the risks which are associated with this particular paper, so they come to light when there is first missing of the cash on the due date. So then you come to know that money has not come, and then he perceives that whether even the principal is going to. Yeah.
Okay. So I'm sure viewers, you have noted this point. So now coming to the more difficult conversation, let's talk about defaults now. So when a bond actually defaults, from a trustee perspective, I'm sure viewers want to know what happens behind the scenes in the first few days.
So as soon as the issuer misses the date on which the payment was to be done, be it interest payment or the redemption payment,
Okay.
right? Immediately the trustee next day has to inform to all the bondholders,
Communication.
right?
Yeah.
That is the first thing what it does, that actually the default has happened. Two, it engages with the issuer and asks him what are the issues or what are the problems which are faced by the particular issuer, whether it was technical issue or it was actually there is some financial strain which the issuer is going through. Then third, what are the possible solutions around it, whether he is going to pay during the cure period or extended period if that is given. Fourth is during this period, whether he is bringing more assets so as to ensure that the security cover gets maintained, right? So that is fourth. And fifth is, in case there is any of these has happened on account of some fraud in the company or on account of some government action or statutory action, in that case we need to see that particular, because in that case it becomes a company wide issue and the appropriate actions then need to be taken.
Okay, so can we say during this entire process, a trustee is constantly doing coordination with the investors?
So as soon as the default happens, the actual work or the real work of the trustee starts.
Yeah.
And what we were talking about, the invisibility of the trustee. So it becomes
Visible.
the fulcrum around which the entire scene now operates.
Yeah.
Right? Be it investors, be it issuers, be it credit rating agency, and in case it is listed, then the regulator also. So everyone comes into play, and entire show it is managed by the trustee, organizing, communicating with all the stakeholders, and then post that calling for meetings, calling for the relevant information, engaging with the CFO, CEO of the company and management of the company, and getting the entire information, analyzing it, presenting it in a lucid format to the debenture holders for taking the appropriate action. So that all becomes the responsibility of the trustee at that point in time.
Yeah, interesting, sir. So, my next question to you is, where does this process usually become most difficult in practice, like legal recovery, coordination among stakeholders, enforcement, or time?
So it's a multiplicity of factors which operate all together. In this, the first thing which becomes the starting point is identifying who are the investors, for which you need a BENPOS. So getting the BENPOS itself becomes a challenge in
Okay.
case of unlisted issuances. In case of listed, it is fairly streamlined because SEBI has put in the norms that every month by 7th working day, the issuer slash RTA needs to submit the BENPOS to the trustee. But in this case, there are no such guidelines. And each of the trustee has put its own systems and processes to obtain the BENPOS from the issuer. So at times I have seen the list of investors or BENPOS which is available with the trustees more than 1 year old, right?
Okay.
So getting to know who the investors are, that is challenge number one. Challenge number two, which the trustee encounters, is engaging with these stakeholders, because at times the DMOG details or the contact details are not updated in BENPOS. So getting to reach these investors is a second challenge.
Okay.
Third is, when you actually try to reach the investors, there is investor apathy, which is experienced at that point in time. In my previous experience, what I have seen, not more than 5-7% turn up. Even though they have invested, they are aware that default has happened, but there are people who don't respond. The investors are not responding, so that also happens. So now, fifth is, on account of this, what happens is there is a requirement of a quorum. There is a requirement of reaching a certain threshold from the majority perspective, majority or super majority, or whatever is defined in the underlying debenture trustee documents. So if those thresholds are not met or quorums are not there, so even valid meetings can't be held. So which leads to the trustee not able to take a decision because it is dependent on the debenture holders or investors to form a particular majority for taking a particular decision. So these are the challenges which are faced by trustee at the time of enforcement or starting of the enforcement
Enforcement
proceedings.
process. Okay, that looks like a difficult job, sir. So, from your perspective, sir, by your experience, are defaults genuinely increasing today, or is the market simply becoming more transparent and formalized?
So default is a function of how the economy is performing.
Yeah.
One, and two, institutionalization of the entire framework, right?
Hmm.
So as of now, it's a combination of both. To say that defaults are increasing, it would be largely that more awareness has come and more people are coming forward and participating. So due to that, we are seeing more defaults. And in the current scenario, there are some pain areas which have come because of the geopolitical issues also,
Yeah.
due to which we are seeing slightly higher defaults at this point
Okay.
in time.
Okay. Sir, on the same line, sir, can we say that investor behavior has changed after the credit events India saw over the past few years as a pattern?
Yes. So what has happened after these credit events, the infamous ones, ILFS and DHFL, etc. So post that, at least investors have become more aware, right? And they have come to know that this is how the enforcement measures are done. This is how the entire market operates. This is the role of the trustee, at least in the larger investor base. That is quite evident now. That's what we have seen. And there is one more episode of Yes Bank 81 bonds which happened, wherein the super HNIs also lost money, wherein the value of one bond was 10 lakh, right? So and people had invested their lifetime savings also there. So those events are also happened. So it created more awareness on account of media covering these events and a large number of investors being there in these particular issues.
Okay. This has been a very interesting and insightful conversation, sir. And of course, we are getting to know the difficult parts of the job too of our invisible but visible hero called Trustee. So, now moving on to our next segment is what India still needs. My first question to you, sir, in this segment is as India's economy expands and more capital moves into bonds and private credit, what do you think is still missing in the ecosystem today?
I think the thing which intrigues me is, as of now, there is differentiation between listed and unlisted,
Okay.
right? So that differentiation has to be there, no doubt. But the laws which are governing this, pertaining to the disclosure and pertaining to wherein credit risk is monitored, I think the two need to be combined. At least those needs to be seen from same lens. That is more important. Or beyond a particular threshold, there has some commonality between the two. I think those things are yet to be aligned. For that, I think we need to take up with the Ministry of Finance for ensuring that two get combined and aligned so that the investors' interest remain protected in both the markets equally, at least.
Okay, so can we say faster enforcement is a coordinate here, like important aspect?
So in India, we have recent in of late, in 2016, IBC came. With the help of IBC, the recovery time has shrunk relative to the earlier enforcement acts
Okay.
with SARFACI and RDDB, which were available as tools, or as of now, the civil codes are available for the recovery. IBC did help to improve the recovery time, but still it's a long way to go. Still, it is hardly one third of the resolutions are happening within the specified timeline of 330 days. Most of them are overshooting. I think a lot of work needs to be done for fast tracking the recoveries from the government perspective on this.
So, do you, sir, think we need better investor education in our country?
Yes, that definitely is required. and so there is a lot of steps which have been taken by various regulators around it, but we are yet miles to go from.
A lot to cover.
Yes.
Yeah. Sir, can India realistically build a much larger bond market without strengthening the recovery and enforcement framework underneath it?
No, obviously the two are dependent on each other.
Correct.
The faster you are able to recover in case something goes sour, that brings the trust in the entire capital market. So if we see post introduction of IBC, the level of defaults have come down. Number two, the number of cases which were to go in default, they have come down. So that is what a efficient recovery measure can do to the economy. So the entire credit discipline has far improved now post this.
Okay.
And if we are able to make it more efficient, definitely there will be more people who would be willing to participate in the debt market.
Correct. On the same line, sir, this question is a little more about an investor's psychology. You think his investor's confidence is ultimately built more by the returns or the recoveries during stress?
I think it is more by return of principal. That's
Yeah.
why I'll coming back to that.
Okay.
Getting the surety that my money what I have invested, that I am going to get back. That is most important in building the trust of the particular investor.
Correct, correct. Hope you have all noted this. Sir, my last question of our today's absolutely insightful conversation is, what is one risk or weakness in India's debt market as a whole that still does not get enough attention even today?
The most important thing in the India's debt market is that the users of capital get the capital at the right rate and at the right time. So ensuring to do that, we are still far away to go from there. I think that's what the capital market has to address.
Okay, sir. Is there something that you would want to tell our viewers as a takeaway from our entire conversation?
The most important thing what I want to share with you is that despite all the issues, I think our debt market is going to go far, far higher than where we are, and it would definitely catch up with the equity market the way things are moving, because the growth rate in debt market is much, much more than the equity market.
Correct.
That's what we are going to see from here on.
Yes, thank you so much, sir. So, viewers, our markets are often judged by growth numbers, how much capital was raised, how many deals were done, how fast a segment is expanding. But long term trust in any financial market is built during periods of stress. And today, in our conversation with Anil sir, we have also realized that the trustee in this entire setup is our hero. So, and as India's fixed income ecosystem continues evolving, conversations around recovery, enforcement, liquidity, and investor protection, most importantly, may become just as important as conversations around returns and yields. So, Grover sir, thank you so much for joining and sharing this lovely information, so detailed, so concise, and so seamlessly with us today. And thank you everyone for tuning in. We will continue exploring India's evolving debt markets in our upcoming podcast and upcoming conversations at Debt Circle. And stay tuned and stay subscribed. Thank you so much. Thank you, sir.
Thank you.